I'm Greg Hunter. Welcome to USAWatchdog.com. With us a guest that came on about a year or so ago, and he was talking about interest rates. This is what interest rates were kind of starting to go up to high twos and things like that. So I think they're going down. Everybody was afraid of them going up, and sure enough, he predicted they would go down, and they did. He is a professional trader. He's been running Rick's Picks at rickackerman.com, professional trading advice. He's an expert in the markets. He has a lot of experience. Rick Ackerman, thank you for joining us today on USAWatchdog.com.
Great, thanks for inviting me on. Always a pleasure.
I just wanted to get to the right to the repo market. I've had people write me, people who are in the markets, and say, "Listen, don't stop talking about the repo market. It's really an awful sign of what's been going on, with the banks and the global economy. What's going on in the crazy repo market? At one point, it was well over $100 billion a night that where they were pumping into the market. What's going on with that?"
Well, you'd think everything had settled out, everything's fine, but I think that the original problem, it occurred sometime around mid-September. You had a run on the repo market, and to me, it's sort of like that cough in the second reel of a melodrama. You remember the film Gran Torino with Clint Eastwood? Well, when he's coughing earlier in the film, you know that it's going to have consequences later. So even though the repo markets have settled down somewhat, I think it was an ominous warning that as to how quickly liquidity can dry up in what is an enormous market.
And what is that telling you about the markets? Everybody, I was listening to I don't know, the financial news networks where all they tell you to do is buy, buy, buy. They don't really give you any real information like you give out in your chat rooms and in your writings that you do. But he was like, "Oh, we're going to get 15%. Oh, we're going to get 3% growth next year." Is everything? Are the repo markets telling us that everything is okay in the financial world?
Well, the Fed had to put an enormous amount of rescue money into those markets to make them calm down. But again, I think the key problem is liquidity. And even when they stress test the banks, whatever they're using is not sort of Six Sigma robust. They're not really accounting for that day, such as we saw perhaps in October of 1987, where everybody kind of steps back. Nobody makes markets. Nobody wants to buy or sell anything. So it's a condition that I don't think you can really test against. And it represents, let's say, the id state of subconscious of the markets. They're also crazed. They're also fearful that whatever got modeled that said we were somehow going to get through it with an infusion of cash, it ain't going to work.
So you don't think all this money printing, in the end, has made the economy? I mean, the way people talk, that everything's fixed, but you don't think everything is fixed. Why and how bad is it?
Well, the one point that I think is crucial, and it's a pretty easy thing to see, we've got a global economy that trades perhaps $90 trillion in goods and services. But if you look at the financial economy, essentially what comes out of the big shell game with derivatives, it's more like $250 billion. So why do you need a $250 billion financial economy to support $90 trillion in actual trade? And the answer is that the business of this planet is not so much real goods and services. It's shuffling paper, and it's kind of stacking, daisy chaining debt. It's extrapolating collateral from things that are 10 steps removed from the real collateral. So what happens is that we wind up with a huge edifice of loans, of credits and debits that all come from collateral of dubious value.
Well, then my question is, well, what could go wrong with a $90 trillion market supported by a quadrillion in paper shuffling?
Well, the paper shuffling is pretty interesting. I look at the options markets closely, and anybody who trades options, you get on a screen and you'll see on a level 2 that there'll be, for some option in an ETF or a stock, there'll be huge markets, 6,000 bid for and 12,000 offered. but those markets never trade. And what they do is the game sort of shifts from one derivative product to another, so that if we're in a period where energy is in favor or healthcare, then all the ETFs in those things respectively get kind of activated. They come alive, and that's really a piece of that quadrillion-dollar market. There's just so much action and side action and bets that derive from some a small game. We saw it in the movie The Big Short. That was about as clear as you could have it dramatized. There was this casino game. There were a couple guys maybe sitting at a blackjack table playing with $100 chips. But out in the peanut gallery there were side bets on each of these blackjack hands. So where you had $300, $400, $500 pots on the table, you had tens of millions, billions of dollars worth of betting out there in the gallery. And that's what we have, really. That's the way the global financial system works.
Wow, we have lots of side bets. Could all this, and this all ties back into the repo market. How? Are the side bets not being paid? Are the banks making all these other side bets on top of everything else they're doing?
Well, the repo market exists mainly to sort of stretch that last ounce of leverage. It's sort of just-in-time inventory for financial products. So what happens is that banks borrow money very short term, and they put up collateral. The best collateral being Treasury paper, and so the loan takes place essentially at one amount, and the borrower pays back a slightly larger sum, and that is really what that's the interest on the transaction. But it's just sort of when you look at it kind of in the context of the whole system, the repo market is just it keeps these huge swings in cash more or less liquid. It lubricates the system a bit.
What's your fear on because you said that we had this attack, this coughing attack, basically. That's how you kind of defined it. And the cough is the signal of something worse coming down the road. So what's worse coming down the road?
Well, we really don't know. And I think there was a very popular book out by Nassim Taleb called The Black Swan. And everybody read it. And the idea is that something that none of us can really foresee is going to happen that will trigger that moment of fear in the markets where liquidity goes absolutely to zero. Nobody wants to trade anything. And the point that Taleb made was that when you start predicting what the black swan will be, that it's going to be some breakdown in the trade talks, or it's going to be this or it's that, you're sort of off the track, because none of us really has a clue what's going to happen. And just like nobody had a clue when the Archduke of Serbia was shot that it was going to lead to the First World War. So it's pointless to try to predict, but I think it's predictable given the size of the markets and this just-in-time piece of it, that it's like a Swiss watch, really, but with a jewel mechanism that's starting to wear down a little bit. Everything runs just in time in the financial business, and these overnight loans settle so that a great deal of money can be bet on things that give you a very small margin. Overnight, you might collect just a little bit of interest, but it takes enormous amounts of money to generate the small amounts of VIG that make it worthwhile.
So you're thinking that, yeah, I mean, we've heard the words black swan and liquidity crisis. Are we headed for? I mean, the system's so out of whack. It's not so much the predicting the black swan. It's looking at the system and going, "Whew, are we? This is a leveraged up, hot mess." I mean, and you're just saying any little, who knows what could go wrong. But you're saying that the system is so levered up that just about there's so many ways for it to blow up. Is that what you're saying?
Well, I think that the point is sort of, it's right in our faces, really, to the extent that we do have these huge credit markets, that the credit edifice, the financial system, is trading in sums that aggregate notionally to a quadrillion dollars. And that is, of course, much bigger than the actual trade in goods and services. So the business of of the real business there is out. It's in paper shuffling, and at some point you're going to have this liquidity crisis. I'd have to say that those of us who have been predicting it for so long did not have the imagination to see how big the game could get before it collapsed under its own weight. When we were back in the 1990s, and I was singing the same song, "The sky is about to fall. Don't try to save yourself. We're all screwed." The amounts then, the big story was that third world debt to some of our big banks would never be repaid. But those sums were on the order of 400, $600 billion. And the S&P debacle was not much bigger than that. It was actually smaller. And, we thought that those numbers were big, but compared to what we're playing with now, they were nothing.
So they just they just printed amounts of cash and funnel it into the market that nobody could ever have imagined them doing, basically.
They did it, the S&L bailout was as close to helicopter money as anything we've seen. Everybody talks about helicopter money, but we don't really, we don't have that. We've got a system that puts money into the system through borrowing. So in other words, when they talk about monetization, they're not just pushing money at the system, it has to be borrowed into existence. So in the S&L crisis, it was amazing how they did that. I worked for a company that had an option to buy, it was a huge housing project in Denver. And at that time, anybody that put on a suit and tie and walked in and talked with these guys who were doing the bailout could get a huge loan. So the loan for this huge housing development was structured so that you could buy up all the units and offer them to the tenants. The tenants could buy them for less than they had been paying in rent. So it was definitely a can't miss deal. And they bailed out just enough of those shaky entities that the system righted itself. But when we got to the next real crash, 2007 and 8, the bailout had to be scaled up a little bit, and it wound up that Lehman Brothers went under. They needed a couple of sacrificial lambs, so we lost Bear Stearns and Lehman. But it could just as easily have been, and it might be the next time, Goldman Sachs. So in that way, the Fed is kind of out of bailout bullets. We've already been through a bailout where it took a big hunk out of the financial system, and each one requires even more bailing out to get to that critical threshold of credibility where the bailout itself works.
And you think that the next time that it happens, part of the problem is just going to be that the Fed, nobody's going to have any confidence they're going to be able to bail it out, or they'll kill the dollar?
It's not possible to kill. It is possible in theory to kill the dollar, but I've always argued and understood everything from the standpoint of deflation. The very simple idea behind deflation is that in the end, every penny of every debt must be repaid, if not by the borrower, then by the lender. So, all the stuff we just kind of laugh at, we wink at, the $1.6 trillion in student loans, for instance. We say, well, some of the Democratic candidates are talking about letting the students simply skip free, but the debt's still going to have to be paid, except that it will be paid by the bondholder and bondholders, so that when they do that, it's effectively going to wipe 3 or 6 zeros from the balance sheet. So we don't really escape debt. And when people talk about the Fed won't let it happen, they're really saying the Fed's going to bail out the system. But if you take just one piece of what they're going to have to bail out, it's going to start with the state of Illinois, which is probably the first state that's going to collapse. It's going to renege on its pension obligations. So if you picture the federal government riding to the rescue, the minute they bail out the Illinois pension system, California's there with its handouts, and New Jersey and Kentucky and a lot of other states, maybe 19 or 20 of them, that have pension systems that are almost as close to insolvent as Illinois. So And you get to the crucial difference. You know, it's one thing for the Fed to pump money into the system in a way that inflates the housing market and the stock market. That's what we've seen. But when you talk about inflating a pension system, it's very different. It means that they're going to be having to mail out checks every month to all the recipients in Illinois. And to keep doing that and to expand it to California, New Jersey, and all the other states that are eventually going to go under is to court hyperinflation. And of course, hyperinflation in that sense you can see where it has to collapse into deflation, because they'll be sending out checks for $600 to an Illinois recipient, but printing so much money that $600 is not going to buy the Illinois pension or anything close to what it would have. So you see that a bailout, where it's really going to be needed at some point, is self-defeating. And if you extrapolate into the housing market, you know, we've already evolved more and more into a home market where people don't even buy houses anymore with the idea that they'll own them. In California, you pay $1.6 million for a crummy little Eichler in Southern California. People buy them, think it's really not worth that, and I'm really never going to have it paid off. So in a sense, they might as well be leasing the house. And so if you talk about a bailout, you're saying you're going to bail out debtors at the expense of creditors. That's never going to happen in the mortgage markets, for one, and that's one reason why I keep saying we can never inflate our way out of this abyss, because you put the homeowner in a condition where he can open his wallet, peel off a few $100,000 bills, give them to his lending bank, his mortgage holder, and say, here, I'm paid. And if you think the lenders are going to ever stand for that, or that the regulators that they're in bed with are going to let it happen, you're crazy. So there is no bailout coming, and it's all deflationary to the extent that so much the debt of Americans it lies within the real estate market.
Oh, I like that. That the debts are. Listen, there's no welching on the debt. Somebody pays the debt. That's your theory is the debt's there. Somebody's going to pay it.
Right, either the borrower or the lender. And if you take our $22 trillion federal deficit that's growing at the rate of $1 trillion a year, it's got to be paid. And it doesn't get paid in a sense of somebody writes a check and makes good on borrowing. It sometimes sort of gets taken out of our lives in ways that are hard to see. You know, the standard of living, I would say, has declined considerably. It's somewhat masked by all of the gewgaws. We have fabulous electronic gadgets and gizmos to make us think that things are better. But where it really counts, where you have families where a single income can pay all the bills and put a kid through college without hawking a third of the value of your house, we don't have that anymore. So we've given up a lot, and you know, it's obvious that with the $22 trillion, it's going to settle against kind of the places where we're laying out the most money, and that is with Social Security and Medicare. So the simple point that I would make regarding deflation there is it's a question, and I think maybe in a previous interview I asked the same question, but it still applies. Do you actually believe that millennials who are living in their parents' homes till they're 35 and are still strapped with college debt, do you think that they're actually going to be able to foot the bills for the baby boomers' Social Security and healthcare costs? And the answer is no. And the irony is that the millennials themselves, they know that. They sense it. They sense that you're 32, you've got a decent job, you're paying more than you think is your fair share into Social Security, knowing full well that you're never going to see a dime of it. The kids, I'll call them kids, they know that much. They know that the system isn't going to see them through Social Security, but they pay it in anyway. The irony is that they're all gung-ho for Bernie Sanders, you know, and other candidates who say, don't worry, government will pay for everything. And the only thing I suggest to people who believe that is substitute for the word government taxpayers. Taxpayers will pay for everything. And you begin to see the truth of it.
Yeah, they're going after the housing market in California. To they have the lid on property taxes out there. They're gonna be, what are they doing? They're going for more taxes, and the public unions, you know, private unions are fine. You're going after a piece of the profits, but public unions, you're going after the taxpayers, and the public unions out there are just looking at more ways to wring money out of taxpayers. I mean, it's awful. I mean that
And
I mean, I drive through Illinois a lot, and they're one of the nastiest states to drive through. They don't mow their roads. They got trees, that used to be not there, as big as your wrist or bigger, in the middle of the highway because they quit mowing. They don't have any money. That's just what I see from just driving through. They don't have any money. You drive into to Indiana, looks like a golf course. Everything's all nicely mowed and clean. Unbelievable. Tennessee, anyway.
and the thing is, all the money, they're broke, and if there's some bond issue or a raise in taxes, 90% of it is going just to one place. It's to keep up the appearances of solvency in the pension system. And Chris Christie, who may not have done anything else worth talking about in his term as governor of New Jersey, at least when he was first elected, he did put his finger on one thing that was he was dead on. He said, if we don't put the teacher pension system on an accounting basis that can be sustained, New Jersey's going to be in big trouble. So his first, right out of the box, Christie was declaring war on the teachers union. But the point seems to have been lost, that we had teachers retiring at age 55. I know two of them. They were both teachers. They became administrators, and they live really well. And they live in such a way that the check comes every month for both of them, and they travel, and they've got a beautiful house, and it's guaranteed. And none of us in the private system have that. If you had three or $4 million in the bank in a nest egg, you could live off the interest as well as my two teachers friends do from their pension checks. So that's an enormously beneficial thing for the public unions, that they don't even need nest eggs. The check will get there and everything will be fine. But none of us, who certainly the self-employed, but none of us out there working stiffs are ever going to experience anything like that. And so you get to the point where, well, how many years do the working stiffs have to work till they're 65, 70, 75 to support public employee retirees who were out and retired when they were 55 or 60?
That you don't think that's going to go on? You think ultimately states like Illinois will just default?
Yeah, they're going to have to renege on their pension obligations, and
Which is what they should do. That's what they should do.
I'm not even saying they should do it.
Well, they promised too much. That's the deal. They promised too much of
they
tax
did.
revenues.
They did, but as a matter of contract law, those contracts have the force of law, and so the unions can rightly say, "Look, I mean, we've got this in writing. You were going to pay us," and you get to the point where the state of Illinois or New Jersey or whichever says, "Well, we ain't got." I remember that played out in the Philadelphia school system. This was decades ago. Philadelphia had a very strong teachers union. I worked for a guy who was one of the union guys in the Philly teachers union. So they, in negotiations one summer, the city of Philadelphia basically said, "Here, we're going to open our books. If you can find this money that you're looking for in these negotiations, you're welcome to it." And I think on a grand scale, that's what we're coming to. The state of Illinois will say, "Yeah, we know we've got pension obligations that are that it's our legal and moral responsibility, but here are the books. If you can find the money, you're welcome to it."
Huh. That's just a cascading. Basically, all these little problems. With the pensions that are underfunded, the student loan debt, the massive amount of derivatives in the market, all there's secret 21 trillion in secret money. I don't know if you've been following that, but that was found by Dr. Mark Skidmore at Michigan State University. That's separate from the 23 trillion that they admit to. So that's another layer of debt. I mean, basically, what we have is the problems are we have too much debt. Am I wrong?
Well, it's huge, and we don't joke about it quite. I think a lot of people have a sense that it's going to amount to a serious problem at some point, but but it's sort of subsumed by other things. We look at a stock market, and the stock market, of course, is at record highs right now, and even people who don't follow the stock market closely are thinking in the backs of their minds, well, we've got all these problems, and there's a $22 trillion of federal, the federal debt, but we seem to be muddling through. And I think the stock market is really the psychological buttress and also a distraction in that way. We're thinking as bad as everything thinks, look, the stock market just keeps going up. That's a whole other argument, and I could give you a dozen reasons why the stock market is going up for all the wrong reasons. But as long as it keeps going up, we think we can manage this. We'll somehow get through it. You could extrapolate Japan's situation from that. Japan has been in a state of deflation or near deflation since the early 1990s. But you have to realize that the one thing Japan had to keep it from actually completely imploding
Savings.
was not savings, but an export market that was still flourishing. So they still had a robust global economy to export into. But if our system starts to deflate precipitously as Japan's did, we don't have anything like that. We have in substitution for the global export market, we've got the Fed, the lender of last resort. And I stress that word lender because in order for the Fed to crank things up to rescue the system, it would have to essentially make a lot more money borrowable than we could need. What they've made so far, what came out of the Trump's tax reforms, in large part was just the ability for companies to bring all these spare dollars back to the U.S. to buy their own shares. So that's one of those things that's given us this bull market that I would argue is happening for all the wrong reasons. And it's all, pay no attention to the guy behind the curtain, but the stock market's going up, and the guy behind the curtain includes such factors as negative yields in Europe. It almost pushes the European investor, global investors, into U.S. stocks because it's not only the best game in town, it's the only game in town. So that's one more reason why U.S. stocks are going up for no good reason. And as long as but there, the black swan doesn't really have to trip some mechanism that collapses the financial markets. We know that, number one, bear markets happen, that this bull market will eventually end. And when it starts going down for reasons that at least nobody in the mainstream media will be writing about at that time, it's going to undermine the false sense of confidence that we have in so many other markets that are just triggered to fall.
Now, you don't think we're going to get a trade deal? You think that's a hoax?
No, I think we'll definitely get one, and it'll be insignificant. I mean, what in all of the complaints that Trump has piled up, Trump has done a good job there, finally being the guy who said, look, enough is enough. They're stealing our patent technology. They're stealing our intellectual property. The companies can't even do business in China unless they surrender all their secrets. And making matters worse, some of the companies are producing hardware with embedded spy chips and things like that. So Trump's concerns weren't misplaced, but to sort of make substantive progress against those things, forget it. The phase one of the trade deal is going to be insignificant. And, we're essentially going to be we'll be giving up on a lot of the intellectual property issues and things like that, just to sell more beef and soybeans to the Chinese. That's really what phase one is going to be all about. So it's a fraud in that way. It's meaningless. But the whole purpose of the trade talks these days is to essentially get a phase two out there. And we're going to be talking about phase two in the year 2022 or 2023. They're in no rush to get these phases done, because as long as we keep talking about it, it seems to be supporting the markets. That's another fallacy, because I would only point out that stocks are higher now than they were before the trade war began. So it's not a question of on any given day you see the headline hopes about a good trade deal have caused the market to rise. That's a lot of crap. The market is simply we're in a bull market. It doesn't need reasons to rise. It's just going up. So the news media kind of sees on the story of the day concerning the trade deal, but it doesn't mean anything.
You're used to be a good big let me stop. So you think there's not really any danger near term, or who knows about the black swan? I mean, you're just saying we're so heavily indebted that yeah, we're looking good at the moment, but who knows at what moment we won't look good?
We really can't predict the black swan. We shouldn't even try, because it's whatever it is, nobody will have thought of it. And I do think, though, that what's going to undermine or bring us to that point of disillusionment or even epiphany is a bear market. The bear market's out there, and none of us perma bears anyway could have predicted that the bull would go as high as it has. I use mostly technical forecasting methods, and I was drum rolling a couple of the usual. This could be it. We've got some major targets up here, and I had a little bit of backup from my friend Peter Eliades, who took very good cycles work, and he was looking at a long-term chart of the New York Composite, which trades up around 13.55, about 13,500, 600, and there was a very compelling trend line there. And Peter still thinks it could work. We could have a move, as has occurred already, just a little bit above that trend line. But this market has really undone the best technicians. Whatever cycles have worked, whatever predictive things have worked for the last 50 or 100 or 150 years, they ain't working this time. So it's a different kind of animal. And I, earlier in our interview, I was just talking about some of the things that are pushing that animal into a frenzy.
You are you still a big gold guy? For a longest time, you were a big gold guy because you thought this thing was going to blow up, and of course, gold's caught a bit of a bid, although it's been under pressure recently. Of course, more people have gone to jail for rigging forex and gold. That was supposed to be a tinfoil hat thing. Oh, they don't rig the markets. That's just tinfoil hat stuff. It's been pretty much proven they're rigging it, and the CFTC doesn't even bother. I guess they're watching porn, like the SEC. They don't even bother doing anything. SEC actually during Marco Polo's is Bernie Madoff allegations where they were found to be watching pornography on their computers instead of going after fraudsters. But anyway, but I digress. Are you still a big gold guy, silver guy, hard precious metals guy? Sounds like you are by what you're saying about the black swan, that you need to have a core position or something. Tell me, what do you think about gold and silver?
I've never been a big gold guy. I've always been kind of a medium gold guy. I have subscribers who are, I think, more bullish than I am about gold, and some of them may be the hardcore. They bury gold coins in their backyard. I'm totally. I think the talk about gold 50,000 or even 5,000 is sort of crazy. And the argument I make to my subscribers is that, when you look at the German hyperinflation of 1921, farmland was a lot more valuable than gold. And in fact, if you borrowed 100% to buy farmland in 1921 before the hyperinflation took off, you could have paid off the entire loan with your first harvest of potatoes. So we shouldn't have any illusions about what gold will be worth in an emergency. The bread truck might come around in the second Great Depression, and you'll offer him a Krugerrand for a loaf of bread, and he'll say, nope, it's 2 Krugerrands today. And so if you're going to trade those, when you get a spike in gold, and yeah, I could see a short squeeze on gold based on all the derivative products that put gold, essentially short sellers, on a hook. You better be quick and clever to bring those Krugerrands to some farmer and say, look, here, will you take these coins for your farm? So I'm not wildly enthused about gold, but I've never had any doubt that in the worst of times, gold is absolutely going to hold its purchasing power. It will hold its value against virtually any asset right now in the galaxy of investables. So that's why I hold gold myself. I just gave my sons have visited me recently, and I gave them gold that I've been hoarding for them over the years. And I guess I was somewhat pleased that neither one of them is going to rush out and turn them into cash. Um, but so anyway, I'm a medium-sized guy where gold is. I'm enthused about it up to a point, and I think it's very good insurance. But I'm not expecting it to go to $5,000 an ounce, and it sort of leaves open as to what's going to happen with some of the miners. You know, a lot of my subscribers are they're playing GDX, which is a proxy for the gold mining companies, and GDXJ, which is has to do with smaller exploration companies. And you're going to get a pretty good pop. And if you look at the history of those stocks, you know that when gold is finally moving, as opposed to just kind of bouncing around as it is now, that those stocks give you enormous leverage. But I have to say, even though I want a piece of it, and I'd make a small bet on it, I'm not really confident that they're going to rise with the stocks in general falling in a bear market.
Ah, I got it. Okay. But you don't see any Mad Max scenario? You don't see any of that kind of scenario? A Mad Max. Some people see a Mad Max scenario that everything just falls out of bed.
I'm a little more bearish than that. I see it as inevitable.
Oh,
Um,
a
and
Mad. Hold on. You see a Mad Max scenario inevitable?
I really do. And I don't,
Explain.
I try not to think about it because, you know, we've all got lives to live and kids to raise. And that's not the message I want to give my kids. They're independent now. They're doing things that are rewarding. And you can't sort of attach yourself to the idea that it will all be for naught. We're all going to hell in a handbasket. But when you go back to that, what we were talking about earlier about the calculus of deflation, that in the end, every penny of every debt must be paid, if not by the borrower, then by the lender. We've already put ourselves into a condition where Social Security is going to fail, Medicare is going to fail, all the kind of just-in-time deliveries of everything are going to be in jeopardy. The companies that serve us, that we buy our food from the grocery stores, we buy one-day shipped merchandise from Amazon. It's going to be, I don't see how all those things can continue to operate in a condition other than the kind of false prosperity that we have now. We're kind of at the pinnacle of affluence, but it's even when we talk about election politics and everything's going great guns, Trump has definitely caused the stock market to move. But has anyone noticed that he has not even made a dent in what we owe? So, and for sure, all the unemployment's down around whatever it is, 3.4%. And that's sort of pushed at us as yet more evidence that the economy's going great guns. But who are those people who are making an additional $1.27 an hour? They're not really getting out of their condition of servitude, and as a whole. And speaking about the middle class, really up to the upper ranks of the middle class, we're not getting a handle on our own debt problem. So even though we have the trappings of prosperity, where retail sales are good and the stock market is high and real estate values are high, it's all just it's delusional. It's inflation. And however prosperous we are right now, we haven't even made an inch of progress in reducing debt and getting debt down. But as I keep saying, we don't have to. It's gonna come down anyway. That debt is all going to be discharged in one way or another.
Your website, rickackerman.com, you have your famous Rick's Picks section. You're a prolific writer. You have a big online community. You have a 2-week free trial on the front of your website. Did I miss anything?
No, I think you got it all. It's rickackerman.com, and There's a thing, a button at the top. If you press it, you get an instant 2-week free trial subscription. The chat room is kind of the heart of it, and I've got a really good bunch of chatters in there. They put out good trading ideas in real time, and it's very much a lot of helpful people in there. So it's fun, and that's the goal of Rick's Picks, is to make a little money, learn, and enjoy ourselves.
And have a forum where people can air it out and talk about everything from the repo market to a Mad Max scenario.
Well, it's I enjoy doing it, and as I said, we've got a great bunch of men and women in there now, and it's just fun to be in there.
Rick Ackerman, rickackerman.com, famous for Rick's Picks. Rick, always enjoyable. I really appreciate you coming on. Thanks very much for joining us today on USAWatchdog.com.
Thank you, Greg. I enjoyed my interview.